This is Module 13A, and before we discuss the master budget, which is going to be the focus of this module, let's go back to the prior module, which would be 12B. Let's look at the 4 practice problems that were contained in your lecture notes so that I can give you some feedback on those. Question number 1 from the 4 practice in Module 12B showed us 2 different companies, X and Y, and the first question asks you to compute the degree of operating leverage, which we call the DOL, for each of these companies. Company X, we take our contribution margin divided by the net income and we get a DOL of 2. We do the same for company Y, and we get a DOL of 3.5. We would say that company Y has a higher degree of operating leverage, and we could also then assume that they have a higher level of risk. Question number 2 has you look at a change in the sales level. Let's look at the drop. It's going to be a 20% drop in sales. And by knowing a company's DOL, which in the case of X was 2, then we will be able to predict that net income is going to drop by 2 times 20% or 40%. 40% would be a $40,000 drop, and we can predict net income to be $60,000. Let's do the same type of exercise for company Y. Y has a DOL of 3.5 multiplied by the percentage drop in sales gives us a 70% change in net income. So our sales will be, our net income will be going down by $70,000. And $100,000 where we began minus the $70,000 drop gives us a predicted net income of $30,000. Let's go to the next 2 questions, and these have to do with outsourcing. And question number 3 asks you to think about if a particular bank, I think we called it First Bank, if it would decide to outsource its data processing function. Ask you to think about what 2 types of fixed cost could be avoided. And I think the 2 obvious answers would be the capital investment in hardware and software could be avoided if you were getting this done by an outside vendor, and also those good salaries of your IT personnel could be avoided. If we outsource the data processing services, the vendor will likely charge us on an hourly basis, which means this would become a variable cost. Therefore, First Bank will trade fixed cost, which were those salaries and that capital investment, for variable costs, which would be those hourly rates. It will lower its DOL and its level of risk. Let's take a look now at the next 2 questions, or the next question, which is going to have to do with whether we keep or drop a product line. And what you see on the screen would be a variable costing income statement. And again, we talked about this in the module 12B, that if we're trying to make a keep or drop decision, this is not the correct format of statement that we need. The problem here is that these fixed costs that we see, and this would be all fixed costs, there are going to be certain costs in here which will not be avoided if we close a department, but they'll simply end up on the backs of the remaining departments. But looking at this first income statement, we see that we're suspicious of these skillets and also the convection ovens, although the steamers looks to be in pretty good shape. As we learned last time, if we're going to make the decision to keep or drop a product line, what we have to do is we have to look at all fixed costs and decide which ones are direct, which means direct, which can be traced to this department that we're considering dropping, or indirect, which means these would be allocated costs that are shared among all product lines or departments. So when we look at the direct, these that can be traced, you have to look at whether these direct costs will go away if you close that department. We call those avoidable costs, or will they simply be unavoidable and get redistributed to the remaining departments. So what you see below, and you're asking this particular problem to complete the decision tree and then to set up a proper analysis, you will see that now instead of using all fixed cost, we only look at the avoidable fixed cost. So instead of looking at both of these in a complete analysis here, let's just look at the electric skillets. The information in the problem tells you that the cost would be broken out like we're going to put here $29,000 direct. That means these fixed costs can be traced right to the skillet department. And the indirect cost for this department are $10,000. Now these are common, these are allocated cost. And what we see here out of the direct, that the next point of the decision tree requires that we determine which of the 29.5 would be avoidable. And in this case, you're told that there's a salaried personnel that would actually be laid off if this skillet department were to be closed. So this would be avoidable because the cost would go away. However, we have other costs related to this department that are actually going to be unavoidable. This could represent, I think in our example, this represented equipment that would be simply the depreciation on this equipment. It would just be used elsewhere in this organization and would be picked up, the depreciation charges would be picked up by another department, so the cost would not go away. So again, the avoidable being the salary of someone who will be laid off, the $4,500 depreciation on equipment. This equipment is going to be put in a different area of the organization and the cost will remain. So because we have this new information, we can present now the correct type of income statement. We're still going to show sales minus variable cost equals contribution margin, but we will only include avoidable fixed cost. And in this case, we have a product margin that is positive of $6,250. And let's show you that. Sales, variable cost, contribution margin, avoidable fixed cost only, giving us a positive product margin. When the product margin is positive, that means we, in a financial sense, will be better off to keep it open because this particular department is contributing $6,250 to the overall profitability of the company. Said a different way, if we were to close this department and everything else stayed the same, by closing it, we would actually cause the profit of the organization to drop by $6,250 because this is the contribution that this one department is making to overall profitability, and that would be lost. Finally, I want to show you, if you close the skillets department, the sales go away, the variable cost goes away, the contribution margin goes away, the avoidable fixed costs go away, And unfortunately, this product margin goes away as well. Let's go back now to the subject for today, which is going to be the master budget. The master budget is the culmination of a lot of planning and is the output of a company's budgeting system. It's important when we think about the master budget that this is really a control device. The master budget is going to give us a plan for what the next year should be in terms of sales and cost, etc. So we will have a plan, and when that actual year takes place, we'll be able to compare actual figures to the budgeted figures. And of course, there will be deviations. And this is how it becomes a control device, because when we have those deviations, then we can ask the question, why? Why were we over budget? Why were we under budget? And allows management to control the expenses of the organization much more effectively because of a well-prepared master budget. I'd like you to look at this flow chart with me, and I hope you have printed it in your content area of D2L. It should be there available for you. But I want to point out that when we do a master budget, which includes all of these budgets, the starting point is always the sales budget. And this comes from a sales forecast from marketing. And the culmination or the last step of the master budget process would be a set of pro forma statements. Pro forma simply means anticipated or budgeted. So let me explain. At the end of the budget year, what we'll be able to do is to actually prepare a budgeted income statement, balance sheet, and even a statement of cash flows, although we really don't pursue that in this particular course, but we will do the other two. I want to point out to you too that the sequencing is very important. The sales budget leads to the production budget, and the production budget is the only budget that we do that will be expressed in units. All the others are going to be expressed in dollars. So once you know the units to be produced in the organization, you're able to do a direct materials budget. We also call that the purchases budget, the labor budget, and the manufacturing overhead. We have another budget here that is called the selling and administrative budget, and this is often based on the level of sales of the company. In other words, the cost driver here would be dollar sales. Where the cost driver for the overhead, the manufacturing overhead, would be units produced. Over here on the side is a capital budget, and this is a 5-year plan as to how the company intends to buy and sell fixed assets. And this is a continuous budget. And what I mean by that is in the first year, you're going to look out 5 years and you're going to make plans for purchasing various assets during that 5-year period. But at the end of the first year, you're going to look at 5 years again. And this is just going to continue year after year, where the capital budget is actually updated at least once a year. Now, what you can see finally from this depiction of the master budget process is that the cash budget is a budget to which many of these other budgets lead. So in the next module, we'll be spending time with the cash budget. We will not discuss it in this particular module. What we can do now is to go ahead and take a look at some of these budgets that you saw on the flow chart, and I'll talk through them with you. this is Land and Company, and this is just one example. We will look at the budgets in the order that you saw them on the flowchart and point out some of their key characteristics. The budget you see in front of you has an input section at the top. This is a sales budget, and I want to point out that in the budgets that I'll be showing you, every one of them has the input section at the top where the information that feeds into the budget is typed in, if you'll look at the cells. But once we get to the body of the budget, which is down here below, all we do is use formulas, and you can see that. And we're going to be using all this information at the top. Now, this is strategically done so that when marketing comes back and changes the sales forecast, which is right here, we can easily update, and this will in turn change all of our numbers in the body of the budget. A sales budget is simply to determine how many dollars sales will we have for the year. You see it's over 10 million. And really, the only information we need would be the following three items. What products are we going to sell? How much, which would be called the volume, and what's the price of each. These percentages just tell us the distribution across the year in terms of how much per quarter. Let's move on now to the production budget. The production budget is going to be the only budget that is expressed in units. You see at the top that we have to enter information about desired ending inventories and beginning inventories. That's because when we have a production budget, we always have units on hand that are there ready for the next period. Very typically, when we end a period, we have units left. Now, these are estimates, these ending and beginning inventory units. These are estimates that are going to be made by inventory control personnel. Again, it's important to point out that accounting's role in the budget is simply to be the organizing party, that we have all this information fed to us from all over the organization, and it is our role in this whole process simply to take all that information and to assimilate it. Management is ultimately responsible for the budget, not accounting. Let's talk about the production budget, and we are looking at how many units we're going to produce each quarter. So if you will look with me at the calculation, and we'll review this again before the module is over, but I want to point out to you that we have to determine how many units we're going to need. Well, we're going to need units to sell. We're going to need units in ending inventory. So we can calculate the total units we need, and then we simply say, do we already have some of those units? And we would in our beginning inventory. So we subtract that and get units to produce. When we look at our second product, which is product B86, we do the same. Needed for sales, needed to have at the end of the period, total needed. Subtract what you already have, and this is what you need to produce. Now we're going to use the production budget to move to what we call the purchases budget, and we are purchasing raw materials X, Y, and Z. Production is going to tell us how much each type of product requires in terms of these three materials. For example, A41 requires 3 gallons of material X, 2 pounds of material Y, and has no requirements in terms of material Z. Over here in the input section, we also have the prices and the beginning and ending inventories. Now again, this is the section called inputs. When something changes, perhaps the cost of material Y, we can simply update this one cell and it'll update the entire purchases budget. Now, the purchases budget, I want to point out, is set up very much like the way we set up a production. We determine what we need, and then we subtract away our beginning inventory. But there is a key point to be made. When we do this budget, we have to do one material at a time. You see X, you see Y, and then you see Z. So we have to do this one material at a time. The second key point is that we do not use dollars until the very last step. You'll see here where I finally multiply by the price per gallon. So what we want to do in the case of material X is compute all of this in terms of gallons. How many gallons do I need? I need gallons for production. I need gallons to have left over, and I can compute total gallons needed. How many gallons do I already have is represented in beginning inventory, and I can determine how many gallons of material X I need to purchase times the price. The production budget, which was in units, is also used in the direct labor budget. In the input section, we have to know how many hours it takes for direct labor for each of the two products. So we can see A41 takes 2, B86 only takes an hour, with an hourly rate of $9 an hour. So the labor budget is very easy to compute. You're just doing some basic multiplication. And in this case, we find our labor per quarter, as you see here. And as in many of the budgets that I've shown you, it also is going to present year-to-date information. Let's go to the overhead budget now, which is going to incorporate something you learned in an earlier module, which is using a total cost formula, where we said total cost equals fixed plus a variable rate times some cost driver. For the manufacturing overhead budget, the cost driver's units produced, and I'd like you to note that this is a total cost formula. $188,000 of fixed cost plus $560 times the number of units produced will give you the estimate for manufacturing overhead for the quarter. So it's very important that you understand this input section ends up giving you a cost formula right here for the quarter. The same setup is used for SG&A. You will see that we have a cost formula here. We have a new cost driver. It is dollar sales, not units produced. But for each quarter, I can use this formula this cost formula you see in blue to go ahead and budget my SG&A once I know my dollar sales. We again have quarterly totals, and then we have what we call year-to-date figures. This final figure represents the $1,727,200 is our estimate for SG&A for the entire year. Now, the next module, we will look at the cash budget in particular, but we will conclude today's module with this SG&A budget. There is one last thing I'd like to show you as a quick review so that you will have this if you need to copy this down. Is if we go back to the production budget quickly, we always want to look at what units we need. We need units for sales. We need units for ending inventory. We compute total units needed. We subtract away our beginning, which is what we already have, and we can determine the total units to produce. And as noted in the left-hand corner, we have to do this calculation for each product that we intend to produce. Likewise, on the purchases budget, that we will compute the purchases budget using either pounds, gallons, square footage, some type of unit, And then at the very last step of the budget, we will convert to dollars. We must use this calculation that you see below for each material. You cannot combine your materials. So we're going to compute how many pounds, for example, we need for production. You would look at how many units you're going to produce of A and multiply it by the pounds needed per unit. You would look at product B. How many units will I produce times the pounds per unit? And then you would add these two together. If we were making 3 different products, then we would have a product C that we would need to add to this calculation. So if we have one product, it's very simple. You just stop with product A. But when we have multiple products, we have to look at how many pounds are needed to produce each product. And then we just look at how many total pounds do we want to have in ending inventory. That gives us total pounds needed minus the beginning inventory, which would be the pounds we already have. And we are able to determine the amount of pounds or the number of total pounds that we have to purchase. Final step, multiply those pounds by the price per pound. Well, this will conclude our module for today on the master budget, but please note that the next module we will continue on with the master budget concept, and we will look at the cash budget in particular. And then finally, a third related module will have to do with the case that we're going to be doing in this class on the master budget, and we'll be going through the details of that in the third module.